Awesome.
Morning, Chris.
Good morning. How are you?
I'm good. I'm Brian Jones. I'm here with professional trader, world's most interesting man, Chris Hood.
Most
What?
injured man.
Most injured. What happened?
Most injured. Brian, I get injured in the most weird scenarios. I'm not going to go into detail, but I fell off the bed and I landed on my face and I twisted my neck. So I'm feeling a little embarrassed actually admitting it, that I've got this agility. My wife, actually, when I start saying things like, imagine if I was more agile, and then she'd look at me and go, what do you mean more? Like, don't you have to start somewhere? Um, so yeah, a little bit of a stiff neck this morning. I just realized that all my major injuries in my life have never been caused by jiu-jitsu. It's always been domestic. It's either in the bathroom or off the bed, like
Bathroom
that's the
can
problem.
really get you. Slippery floors, trying to
Oh
get in
my
the
God.
shower.
I think that there needs to be a warning sign put on the drain in a shower, because I got caught on the drain on a shower and I turned and I ripped my knee up. And I had to have surgery on my knee because my foot got stuck on the drain, and I turned to turn the tap off and my foot stayed still and my hips rotated above my knee and it just took out the whole cartilage in the knee. Terrible.
I hope you
Horrible.
took it out on the shower. Just ripped everything off the wall.
Yeah, nowadays I'm the most, I slide out on my butt. I think that's the safest way, is just not to use your legs at all, just slide out. So yeah, world's most injured guy at the moment in a post-election Canada, which I have to admit, I'm not the most political person, but to spend $680 million or $610 million to get an extra 3 seats in parliament, I think that the government here needs a little lesson in economics. What a complete waste of time and money, and it's just ridiculous. Honestly, don't get me started. It's just crazy. So listen, how's this? For 36 days, we've had to put up with these clowns on television telling us about how bad the world is. And it cost $610 million, and they came out no different from how they went in. Exactly the same.
That's pretty much the standard. It's the same thing happens. The same things happen. I don't know. I'm increasingly apolitical just
Yeah,
because
I'm agnostically political. I don't care.
I mean, I have my
There's no,
opinions on things, but like I never seem to find them all in the same package with
yeah, absolutely. Yeah.
so
I find that what you've got now is in Canada particularly is I cannot understand this. And I thought about this in the States as well, right? We're pretty smart countries, all right? We got pretty intelligent people that live in these countries. I've never met a non-intelligent North American, right? Whether it's from Canada or America. I've never met them, okay? Maybe they are, but I
I'll
don't bump
introduce
it.
you, when you come down. I'll introduce you to a couple. Just
Okay, rather let me keep the image, right? Let me
okay, no,
keep
yeah, I won't do that. I won't do that to the United States' reputation.
But here's the problem. In countries with such a great and diverse population group, is this the best we have? Like, honestly, like I look at the leaders that we've got here in Canada and I'm like, there has to be better people. There has to be. There cannot be no one better than these guys. I mean, these guys are a bunch of, I don't think any political party here has a monopoly on intelligence. I mean, they are not clever people by any stretch of the imagination. No offense to the people who decide they want to be politicians, but honestly, I think there are a lot of people who could do a better job. And it's the same in America. Like, you got 300 plus million people, and yet in the last election you had 2 geriatrics, one who couldn't string a sentence to each other, and one guy's got bad hair. The guy with bad hair won, by the way. I don't know, but anyway, you know what I mean. It's like,
Right.
where do we get these people from? Can't we encourage more, better
Do you
people?
vote for, do you vote for getting punched in the face or punched in the solar plexus or whatever?
I'll tell you this: in Canada, there's one politician who's actually a jiu-jitsu blue belt, and he could come out with the most left-wing communist thing, and I'll still like the guy because he's a blue belt, right? Because at least jiu-jitsu has a physical douche filter. That, if we really wanted to filter out the best people, put them through a ringer, get them into a Shark Tank. Let's see if they can survive a 2-hour Shark Tank, and then I'll vote for the guy, right?
Yeah.
But crazy, man. It's just the waste of money and just the whole idea of why they did this election. Oh my God, it's just nuts. It's crazy, man. Crazy. At least I know my money's getting wasted somewhere. You know, that's
So
sorry, that was my political rant.
that's
You
okay.
don't get it very often, but I'll do it anyway.
Yeah,
You know,
no, I like to hear your opinions on this.
man.
So what do you
I
think?
think they should do that though. I really believe that every single political candidate should be put through a physical test. You know, like put them through a physical ringer. I want to see them box. I want to see them wrestle. I
Yeah.
was waiting for the candidates to come and campaign at my door. They were damn lucky they didn't get me here, because I know one did, and she dropped off some stuff in my door, like pamphlets. You know, I threw it away anyway. But I was really hoping they would come and see me, because I would ask them, you know, tell me about Afghanistan. Tell me about all of these things, you know.
Instead of
And
an election, they should have like a free, like a elimination tournament, single elimination tournament,
a single death. Yes, I like that idea.
like duels, like individual.
Yeah, absolutely.
Keep
Yep.
moving up the ladder.
Yeah, let's push this guy off his horse. First one to lose, you know. I like that idea. Politics at this point, politics in Canada is very apologetic. You know, it's not as brutal as it is in America. Like in America, you guys are a little bit like, you go for the jugular. You know, you guys don't mess around with wrist locks, right? You go straight for a rear naked choke. You'll just go for it, you know. Here, it's a little bit too polite. And it's not, the issues, like you said, is like, you can't really find one party that appeals to everyone. It's like a little piece of this guy and a little piece of this guy. And if they, you know, joined those two, that would be a great mutant that we would vote for, you know. But you got, and the problem here as well is you can't vote in a sort of, well, he's so bad, so I'm going to vote for this guy who could be just as worse or just as bad, or if not worse. So it becomes a really difficult conundrum, because you can't split that vote. The last thing we need here is Trudeau to have a majority, because then there'll be just more money printed. Inflation is now at the highest it's been in Canada for a long time, because these guys are just spending nonsense. I mean, they're just wasting money.
What do you think about So let's kind of look at this from a market perspective. So, I mean, well, obviously, we could talk about inflation, but let's address the giant gap down. They're probably smashed.
Yesterday's move. Well, you know, we've been talking about September and October being crap for 4 months, right? So this is not a surprise. You know, all of us have been preparing for this. It's not an unexpected move. People will say, oh, well, you know, the Chinese, and it's this big real estate firm that decided to sell electric vehicles and bottled water. Go figure. You know, just nuts. I mean, $300 billion of debt is huge. It is a preposterous amount of money, right? And the Chinese government is sort of stuck between a rock and a hard place, because they really want to discourage this over-lending, this over-leveraging that they've got. And, you know, there are a lot of people that are employed by this company, right? So this could trigger, I think it could be a contained event. It could trigger a bit of an Asian problem, right? I don't think it's going to affect the Americans or the markets over on this side as much as the sentiment. It's more like a sentiment issue. It's like, oh my God, everyone's been borrowing too much money. Let's deleverage everything, right? And then the banks start pulling back. So yesterday's move, I mean, we've always been saying that September is going to be a bad month, right? The problem that caught me a little off guard was the extent to which yesterday's open was such a big gap down. So I wasn't expecting a huge gap down. I'm always expecting like a drip, right? Like down, 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 like death by 1,000 cuts kind of thing. Yesterday was, I don't have time to sit here and whip you for the next 3 months. I'm just going to smack you once. And quite honestly, that's the better way to do it. I prefer these big sell-offs, because with the big sell-offs, we get to these extreme levels faster, number one. Your opportunity to recover is better, because you tend to have this thing like an elastic band. The further we stretch away from the mean, the harder things can explode back to the mean and possibly push us back to the other side. So I'm not surprised, number one. Number two, could this be the start of something bigger? Probably. Will this last for a long time? No, I don't think so. Tomorrow we have the Fed. I think it would be very, very poor optics if Jerome Powell comes out tomorrow and starts to say, oh, well, you know what, we're going to start tapering everything after yesterday's move. I think if yesterday's move didn't happen, The possibility of the Fed triggering something tomorrow might have been a little higher, but I think it's in their interests to probably just calm the market down a little bit. The irony of all of this is if you look at the disclosures of the Fed members' investment accounts and you see how they've been positioning for the last 6 months, it's sort of like the line between what's allowed and what's not allowed becomes very blurry, right? So, best thing, like we said to clients last week, was trade really safely. We don't want to add overly bullish positions and directionally bullish positions when the market is sort of teetering at the top. So last week we didn't add much. We did add quite a few insurance positions that paid off well yesterday. Now, whether we leave those insurance positions on and see what happens today, you have to take each day as it comes right now. But we are chronically extended. Yesterday's movement was almost a 2.5 times move, right? It's 2.5 standard deviation move. So a lot of technical damage gets done on charts. So we've had technical damage on Google, on Amazon, on all of these charts, and now it's a matter of repair. Can they repair today? We'll see. I don't know. We'll have to see exactly what happens. But as far as my clients are concerned, a lot of them were making their positions a lot smaller. They were taking positions off. We started doing this back in June. So, we usually run quite a big book in terms of number of positions. We dropped that down by 60% between June and September. We knew this was going to come. It's come. There's no surprise. The question is, the people that get annoyed about days like yesterday are the ones that generally don't follow what the market is saying. They tend to, only trade in one direction. They tend to shorten the hole. They tend to buy at the extremes. Those are the guys that take the most pain, right? So, it's sad that we see it. It's always horrible to have a bad day, but these are very, very healthy moves. And we're not that extended in terms of the overall picture, right? It was a big move, but if you look at the overall graph, let me pull up some charts and we can have a look at it.
And just 1 second.
So when you look at, let's open it up here first. Let's look at it from this perspective here. So if we look at SPY, we are now down at the 2 standard deviation move here. That's what we've got. All right. So it's not a huge move to the downside just yet. We could still go all the way down 435. I think we could get a hell of a lot lower. Let me open up one of my other charts that has got more detail on. So when you start looking at where could this possibly lead to, I think we could possibly go down to the weekly 21. So this is where the charts are really important. You've got to know where the support levels sit, because these kind of movements, these big movements that we have, these gaps down, if you look at that gap, this has to be filled. This needs to recover in some way, shape, or form. All right. So this is going to be really important to see how the market recovers from yesterday. So right now we're at the 34. This is our next layer of support, is at 411. Could the market drop another 5%? Yeah, it could. But, are we going to expect it to happen anytime soon? We'll see. It's a little bit, if the Chinese government comes out and says that they're going to, bail out these guys, man, it was quite interesting reading about this company. They initially started off on property and they got into bottled water. I'm like, this is crazy, man. Like, talk about building your business.
Yeah.
But they've got these 2 interest payments that need to happen. 83 million and I think 40 million, somewhere around there. Let's see what happens. I've got their stock code here. Let's have a look at their stock. Not this far. It's not on Forex. There it is. If you look at it over the last, couple of months, let's just pull this up a little bit. Over the last year, that gives you an idea of how the stock has performed, right? So this is the company itself. The bonds were trading somewhere around 25 cents to the dollar a couple of days ago, last week, Friday. So that's priced to die. Once you start passing the 50-cent mark, your chances of survival are pretty low. But this is what's been happening to this company in Hong Kong, over the last the last year, right? So not the best company worth looking at. I don't think they'll get a bailout. I think that the government will use them as an example, but who cares what I think? At the end of the day, it's the overall condition that you've got to be aware of in the market. So if we look at SPY, let me go into my charts here. So if we look at the SPY on this basis, sorry, I'm switching all over the place. This is the weekly graph. This is the daily, and this is the hourly, right? So on the weekly, we're not even down below the 21 here. Like, we haven't done anything really. This is just a healthy pullback. If we look at the graph and we see when last the market actually hit the 21, that was it back in March. Every time it's hit the 21, there we had the 34. Every time it's hit the 21, it was a great buying opportunity, right? So here we have possibly another great buying opportunity. The difference is, at the time, if you look at what we've got at the bottom, we've got no moving average support. We've got a negative momentum on the top squeeze. Our wave score is dropping. It's nearly crossing below 50. We've got a stochastic sell signal on the weekly. Our trend is still up. But could this fall further? Yes. Okay, it can. Now, if we compare the moving averages, the TTM, the wave score, and the stochastic, and we go back to when last it hit the 21, if you look over here, we had a rising TTM, we had a rising wave, and we didn't have this potential to cross zero, right? If you look here, this is falling at a much sharper angle. So the conditions are different. I think where we were there is very different from where we are here. So you've got to be careful about that. You know, it's different. It's not the same. So trend is still intact. Could we fall further? Yes. I've got these alerts that are on play here. If we sort of get down to 425, I come back in, have a look and see, do we have moving average support? What's the wave score doing? If the wave score is turning up and we've got some green dots that form over here and we've got a little bit of yellow forming here, that may indicate time to go back in. All right, but this is a weekly chart, so we've got to see where Friday closes for this candle to print. So it's still 4 days away. So we've got quite a bit of work to go here. If we look at the daily, you can see the standard deviation lines are moving to the outside. So the squeeze is already firing short. So we know that this price is going to be dropping down. Moving average support is bearish. Our B score is negative. So we know that there's a lot of momentum, downside bearish momentum, that's now hitting into the squeeze that's going to push the price down. And we've also got this reaching levels of being oversold. So we need to watch this carefully. When this starts to turn and this goes back above zero and we start seeing yellow bars on the squeeze histogram, we get some green over here, then it's time to go back in. But right now, definitely not the time worth going in at the moment. So we've got a lot of reversal signals, negative momentum. We're trading at the bottom of the vol range. So, you know, aggressive traders can go in and sell puts, but, you know, I would personally just wait because we've got no bullish support for the structure of the trade. So that would be something to avoid right now. Just wait till we get confirmations. Looking at the intraday, you can see point of control for yesterday, it held. It didn't break. So from here, we can see the squeeze starting to show a bit of signs of life to the upside. Our B scores above 50. We're moving into an overbought scenario. So from here, we could expect a bit of a bounce. And if you look at yesterday's movement from around, it was about 2 o'clock. When you look at the final hour of yesterday, this candle really saved the day. If we didn't get this candle yesterday, we didn't see an after hours break of point of control, we would probably be gapping down again today. So this technical pattern that formed over here with this break to the upside, this break of point of control, and then this gap up this morning at 4, this is really, really important for today. So what could happen, okay, is a recapture of the 21. And with the increased bearish momentum that we have here, that could be a shorting opportunity. So a lot of people yesterday may have bought put options. They might have been shorting, you know, but they're shorting down at 3 standard deviations. And what happens is this movement back to the 21 wipes those guys out. So when that wipes them out, we're going to see if the 21 can hold. If the 21 can hold, then this is just another dip buying opportunity, and off we go to the races. We'll probably be at all-time highs in the next couple of weeks. But if the 21 fails, so if we fail at the blue line, if we fail at this red line again, so we've got to come back up, we've got to touch this red line over here. If we fail there, then that's definitely a shorting opportunity. So I've got, a couple of things that I'm looking at. I certainly would suggest, if you're looking to short, don't pick a stock, just pick an index. The easy money at the moment is definitely going to be the Russell. So shorting IWM, a 30 delta put option 60 days from now, looking at the November expiry, that would probably be the no-brainer put option trade on IWM. But you need to get it in closer to the 21. You cannot be doing it down here. These levels, it's too extended. So we're going to wait for the 21 and then short it on the way back down. That would be the easy one. So watch this recover, wait for it to break the 21. So it needs to hit the 21 and fail. Then we would short it to the downside via a long put, 30 delta, 60 to 90 days out. That would probably be the trade that I will look to do. But now, having said that, there's still some opportunities, right, in the market. There's still some things that look pretty good. One of the trades that we've got on is obviously shorting the NASDAQ. So, we've been buying these short shares. This is an inverse ETF, shorting the Qs, the unleveraged short of the Qs. You can see what happened here. Formed a base, started to crossed over the weekly 21. Now it's moving up. So we've got momentum on our side. We've got a buy signal, and our B score is rapidly rising towards 50. So when we have that condition, this is an opportunity to enter a trade. This is on the weekly chart. Look at the daily pattern. We had a buy signal trigger over here on the cross of the 21. Now we've consolidated. We've got further bullish momentum. B score above 50. 2 days ago, bang. When we got that signal on that yellow candle, this is a very powerful signal for us, is on the squeeze with a yellow candle. If we get a rise above 50, that's a trigger. That would have been the buy signal. We bought in, I think we bought in over here, and we bought in an extra set over here. Even though we had a reversal signal, a sell signal here for that entry, the overall conditions still warranted a buying opportunity. So short-term traders could have taken profits over here. We stayed in for the longer haul as a hedge position, and we got the big move yesterday. So this kind of signal where you have moving average support, histogram slingshot, okay, we didn't get the squeeze, so we would ideally want a red dot here. But because we had that lowering of momentum, so we had signs of exhaustion, this is the key. That green dot, the cross of the B score above 50 on our wave, is very important, because that tells us the squeeze will fire to the upside. So we knew that from this position here, based on this and this, that we would get a light blue histogram on that following day. We get into the trade, we get our 20% the next day. So this is a very powerful series of indicators that we use, particularly the B score. If you use the B score together with the squeeze, it's almost like this, the B score operates maybe one time frame cycle ahead of the TTM squeeze. So it gives you an idea of direction, and then you can obviously trade amplitude via the squeeze. So a powerful signal. We got into that one.
When you're shorting, you said that you like to you do some long puts, bear put spreads, but you would prefer to, would you prefer to do calls on the inverse indexes, or?
Pretty much the same. It comes down to price. One of the things that I notice a lot with some traders is, there's no holy grail here, yet many people think there is. All right. So your success as a trader is not going to be based on your combination of indicators, right? There's no such thing as this indicator is absolutely faultless, and if you trade this, you will always make money. There's no such thing like that. So any type of advertising in that way is a little bit false. It's a little bit misleading, because the big difference is between traders who make money and traders who don't make money is not necessarily the indicator they use. It's the psychology that they apply to the trade. So it's how you manage the trade, whether you got it from signal A, signal B, it doesn't matter. That stuff is almost irrelevant. So when I trade and I look at it, the second thing that makes the most difference is sizing. Sometimes buying a bear put spread, what you give up on a bear put spread in highly volatile markets is this impact of positive vega, right? So as soon as that market explodes and suddenly volatility spikes, you don't get as much of the upside on that bear put spread as you would with that long put, right? So the way that I like to trade it would be, I use a very deep out of the money put butterfly that's wide, all right? And then I offset the negative vega element of that put butterfly by buying a long put that's cheaper. So I can offset it. So my total net cost is often less than what would be if I bought just long puts by themselves. So it's cheaper. B, my risk reward is a lot better because I'll end up doing the butterfly on a 10-to-1 risk reward, and then I add the long put in as a volatility kicker. So it can offset the impact of that middle strike, dragging the price down when the volatility spikes. So a lot of it comes down to the psychology that you use to manage those positions. When people get scared, they tend to defer to, oh, I'm just going to buy puts. And the problem is when they buy these puts, they're always buying them at the worst possible time, right? So the people, and sometimes the guys who sell the puts are also selling it at the wrong time because they're not looking at the market going, well, could the market gap down tomorrow, right? And if it gaps down tomorrow, the guy who sold the puts is going to get absolutely hammered, and the guy who bought the puts is going to make some money, right? So there's always this disconnect between the decision to do a trade and understanding the internals. So it's almost like for retail traders who don't watch the internals and they don't watch these divergences that happen, they tend to trade based on risk, not just risk, but the reward and the premium. Those are the two things that go into people's heads. It's like, but I can make $5,000 and I'm only putting down 100 kind of thing. They don't really look at the probabilities. They don't look at any of those factors. So as you start building your trading system, the system that I have that works for me doesn't necessarily work for everyone else because my mental makeup is different from other people, right? So if I gave you, I know that I've done this with my clients. I give them my exact blueprint. I tell them I do this, 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 right? And I give it to 10 people. All right. I might have 8 people who do it really well, following step by step, and I have 2 people who don't do it really well. And it's not because the sequencing is wrong. They did everything the same. It's their emotional makeup was different. So they might have done it at the wrong time. They did the same action, but they did it at the wrong time. They got scared. They might have oversized. They might have undersized. They might have tried to think their way out of a problem rather than trade it out of a problem. And that's where the differences come in. So when it comes to signals and indicators, all right, basically what you need is an oscillator, a stochastic that tells you, in terms of overbought, oversold. So you can do slow stochastic, you can use an RSI indicator, whatever it is, and you need a momentum indicator. You need a momentum indicator, you need a slow stochastic or a stochastic of some form, and you need to understand the relationship of the moving averages. All right. So if you haven't got those 3 in your trading system, whatever they might be, if someone comes to me and says, well, I trade the 8 and the 13, and then someone says, well, I trade the 9 and the 21, it's all the same. Right? At the end of the day, you might not get the same signals, but you're trading off the same principle. You as a trader have to build something that works for you. The best system is the one that works for you. Like whether it's system A, system B, system C. The problem with a lot of people is they don't give any form of system enough time to work. So they're always looking for the next one, then the next one, then the next one. And I'm going to admit it, I was an indicator junkie for many, many years. It's like, okay, what's the next best indicator? What's the next best thing? And, I think I've got maybe 21, maybe 30 indicators that I use at any given time. And I use them, but they all provide a layer of analysis. I don't rely on one signal to tell me to do anything. It's a combination of things. And my level of interpretation of those signals is what makes my system work for me. So as a trader, if you're starting off new, simplify stuff. All right. Don't put pressure on yourself to build the world's best trading system because there isn't such a thing. There is no such trading system that will be perfectly faultless time and time again. It doesn't work like that. what happens is some of the best trading systems are only 40% correct, but they manage their losses really well and they manage their risk really well. If you get those two pieces right that are not based on your signals, you'll be profitable. Where most people lose money is they oversize, and they oversize for ego issues or greed. It's one of the two that's going to come out. So when we look at the market, we look at opportunities, try and understand the conditions of the market. If we feel that the market is overtly bearish and you need to have some positions that are going to be towards the short side, make a distinction between hedges and trading positions. Those are two totally different things. Hedges are my worst trades. I don't make money on hedges because their objective is to minimize volatility on positions where I've gone excessively long. So if I've got a really long book and the market's getting a little bit frothy, I need to put hedges in to minimize the impact on my net liquidation value. I don't look to trade them. I don't trade hedges, because if I make money on a hedge, it means I've lost money somewhere else. When I have a trading position, that's a directional trade in whichever direction it is. Those are completely different. I trade those very differently from each other. So when we look at the market, I would be looking at, building in some trading positions around shorting the NASDAQ, shorting IWM. I'm looking for that break of the 21. Once it gets back to the 21, if it starts to fall, I'm going to add some more to those positions, because I think that between now and maybe middle of October, I think we're going to be suffering a little bit. I don't mean suffering in the sense that we're going to be looking for bread and milk and, all of that. I just think it's going to have excessive amounts of volatility, that if you've gone directionally in one way or another and you've got a lot of trades expiring between now and maybe the first week of October, it could be pretty painful. But you've just got to be calm. Like at the end of the day, this is not going to last forever.
The question is, what's the market going to do, Chris?
I checked my crystal ball. Unfortunately, it broke. It's anyone's guess. At the end of the day, if you spend too much time trying to predict, you'll be wrong. It's like, you'll be wrong. We put on our short positions on Friday because it was a Friday. We didn't know yesterday was going to happen. And when we woke up yesterday and all of our insurance positions we put on Friday paid off, there was no secret source. There was nothing that told us on Friday that the market was going to drop. What we had was the charts in front of us and the market sentiment. And it just looked like the bulls just couldn't get anything together on Friday. Usually what happens if Friday's a bit of a bad day and you've got a weekend in between, Monday's normally not an up day, right? So it's just understanding that part, right? So what's the market going to do? It's got to correct itself. It has to come down, whether it goes down below 3 standard deviations. So let me open up SPY again. In fact, let me open up my chart. Give me a second. I'm going to find this one chart that I've got where I actually did some work on the SPY, doing a whole lot of predictions, right? So let me open this up. It's somewhere. Give me a second. Just bear with me a little bit.
The forecasting, you said that you're a little bit skeptical of a lot of market forecasts, because a lot of people I read like financial analysts, and they kind of they're like, this is what the market is going to do.
Yeah,
100%. And
yeah, I mean, look, forecasting is, I put zero weight on it, right? So like what I'm about to show you should be treated like a fiction book. Okay, this is my story of what I think will happen, and what this does is it allows me to see if I'm right. All right, this is what I think is going to happen. Okay, this is my forecast, right? So I think we're going to get down to around 410, between 400 and 410, somewhere around the 15th of October. I think we're going to reverse from the 15th of October after monthly expiry. And I think we're going to hit around 463, 470, sometime around 17 November. Look, if I'm right, I'll take a beer from anyone that wants to give me one. I'm more than happy for that, okay? What I'm saying here is I'm not expecting this to happen as it is, right? So let's just caveat this whole thing, okay? This is about as accurate as this is about as much chance of winning as me being a world champion in the Masters, no, in the adult black belt division this year.
But here's what we'll do. Here's what we'll do. If the market, if it turns out that this is correct, we'll leave the YouTube video up. And then if it turns out that this is wrong, we'll just delete it.
Yes.
And then every time you make every time the market does a little something strange, we'll just take that one out.
We just correct it. Yeah. So let me explain to you how this works, right? So this is just what we call a ghost feed, right? So this is based on previous information provided by the existing charts. And it just predicts, right? It just looks at volumes and it predicts the type of candle pattern that will happen. Now, I did this on Friday, okay? I used Friday's candles. I went down, I looked at the option market. Where's the option market expecting it? Do we think it's going to go down the market? Well, how do I know it's going to go down? Because A, my alpha score has dropped below 70. B, I've got negative moving average support here. So I'm losing momentum in terms of trend and sentiment on the moving averages. I've gone from a sell signal, overbought signal. I'm coming down now into the oversold signals. My B score is below 50. My squeeze is fired short, and I've got the bears in here on momentum. Okay, so there's nothing telling me this is going up, right? So here was the open yesterday. This is the candle from yesterday. We were predicting a sort of green candle up here around 1 standard deviation. What we got, oh, sorry, that's a 2. What we got was a 3 standard deviation move at the open, right into the Ichimoku cloud that we have here, the daily Ichimoku cloud. What does this mean? Well, now I'm trading in a cloud that's known to be choppy, right? So when you trade inside the Ichimoku cloud, the conditions are choppy. It's like flying through, in an airplane through clouds. It's turbulent. So I know that we're going to have turbulence here. Do we come back up, rejoin the line, and continue down towards 410? Is this where we're going to go? Let's just add our Fibonacci layers on to see where we could find possible layers of support. So if I look over here, we're right on top of this line at 433. Could we drop down to 430? Could we drop down to 427? All of these lines need to hold. So technically what we're looking for is either for the market to push back up and turn these levels of resistance into support, or we're looking for it to continue to fall. It's just giving us an idea of to where it can go. Can this happen? Absolutely, because my bottom line there is 398. So my expectation in the options market is somewhere between 400 and 410 at or around the 15th of October. Now, maybe I'm completely off the charts here, like completely off, and I'm, gone mental. Okay, that's fine. But what I'm trying to do here is to see whether or not my expectation of the market will be right or wrong. Okay, so that's all I'm looking for, is I'm going, okay, based on that data, this is what I expect. If this suddenly shoots back up that way, I will adjust, right? Now I'll look at the indicators underneath and say, well, was there anything underneath when we added this, this feed that told us something else? And that's how I can correct signals. I can correct them to see whether or not something was misreading or whatever. But for now, we have a very, very bearish outlook in terms of the short run up to the 15th of October, with a bounce back up to 460 by the middle of November.
So this low price, is this sort of the prediction of the predicted move?
Yeah, it's the expected move for that expiration. So every day you can adjust this chart, right? Because the expected move is going to alter all the time. So once we start altering the expected move and we start, let me just take these off because it gets a bit noisy for me. Once we start taking this and readjusting it on a daily basis, it just tells us what we can expect. It doesn't tell us what will happen, right? So if you took someone who said, no, every time we've crossed the 55 or the 34, we have a buying opportunity, they might be very bullish now, all right? If someone could convince me that there's a bullish signal somewhere on this page, I'd be happy to look at it. But a bounce from here to here, right? So if we look at the pre-market's going to open at 436. We're going to open over here. I wouldn't call that a bullish reversal. not just yet, right? So you've just got to look at it from the perspective of, what am I trying to do? My whole goal right now is to get to this point here without losing too much money, because I'm going to make back a hell of a lot more on that move up than I am going to lose on this market move down. So for retail traders, this is not of consequence. Okay, what causes people to lose money now is they go, oh, it has to bounce now. It has to bounce now because it's there. It doesn't have to do anything, right? It doesn't care what you think, and it doesn't care what I think. It's going to do what it's going to do. The only thing I can do is scroll down, look at my charts and look at my indicators and go, oh, well, based on this pattern, normally what happens is when this gets to 50 and we get a green dot. So when you're in this situation and you've got improvement in the moving averages, alpha score above 70 and a green dot, well, we tend to see prices rise from that perspective. So I'm looking for the same conditions to appear, and then I go long. And until such time as those conditions appear, I will continue to trade short-term short. That's how you trade. You build a system of analysis that allows you to see these things, and then you trade accordingly. Do I care that the market's down here? Not in the slightest. I really don't. It doesn't make a difference to me. You just trade differently when the market does this as opposed to when the market's doing that. And that's where retail guys really need to concentrate, is not trying to force their bullish trades that may have worked in this trend up here into a market that's doing this. This is what kills people. It kills your trading. So if you've been doing, this is why I don't like that wheel strategy, right? The wheel strategy is selling naked puts till you get assigned, and then sell covered calls until you get assigned. The problem is you get assigned on an index. Let's say you got assigned at 452, you get assigned here. And now you're going to be selling in the money covered calls during a period that does this. Your premium, you're not going to be getting enough premium out of the money to ensure that if you got assigned, you'd be outside of your strike price. Like, this is the real key, right? If I sell in the money calls over here and I have one reversal day or one reversal week and I get assigned on that trade, I start losing money. I'm throwing money at losing trades. So selling naked puts here or selling naked puts here is a dangerous strategy, because you could be assigned and never recover. That's the problem. So if you're willing to accept that risk, by all means, that's a strategy to do. Personally, for me, I don't do it. I would rather trade directionally based on confirmations of the indicators and trade to the downside where I've got a higher probability of winning, rather than taking a strategy and saying, oh, well, it must do this or it must do that. Market doesn't have to do anything. It could turn around and kick you in the nuts 20 times in a row and not feel bad about it. That's the hardest reality of trading, is the market just doesn't care what you think. So you need to have strategies that work in all directions.
You just kind of plan for the what if scenarios. If it does this,
yeah.
this, if it goes here, I do this.
Yeah, so this is why I have these price triggers, right? So if I have a price trigger up here at 437, if we breach 437 today at some point, and we've got bullish momentum on the intraday, that's a setup for me for an intraday trade. If we breach this level down here at 425 and we're moving to the downside, I have intraday trade setups that I will use on that signal. So these are my levels, right? I'm looking for a breach of the top of the Ichimoku cloud, and I'm looking for a breach of this line here at 425. Once we have that, I look at the signals, I then decide which way I'm going to trade. And I've written down exactly which way I'm going to trade based on what signals being triggered. So it's not a question of having to think it through when the stuff happens. I've already thought it through. I just wait for those triggers to occur. So one of the things that I like to do is put on, different indicators at different times, right? So this is an indicator that I use explaining to me, or showing me about prices extending above the third Keltner across multiple time frames. So I know that the move yesterday was an extreme move. So this is telling me a reversal is imminent. This is telling me a reversal is imminent. What happens? The reversal starts to happen. What happened?
Is this one of your indicators, or is this something that is with?
This is one of the indicators that I've built. So my subscribers get this. They can use this. It basically just tells you when a price reversal is imminent, right? So every time we get these little red triangles to the downside, we know that a pullback is going to happen. and you can see the accuracy. We get that signal, you would have exited the trade there. There was your pullback. You had 3 chances to exit. So I get pretty strict with my clients, right, who are using these indicators. Like, if you don't get out on these signals and you suffer this, there's not much I can do, right? If the signals are telling you to get out and you don't listen to it, there's a consequence, right? We've got different indicators. You can use a simple reversal and momentum signal that we've got here. Different signals at different times, right? Obviously, with put spreads, we use the volatility range. These are not triggers, right? These are just telling you bottom of the vol range setups that you can use. Here we're looking for straight reversals of momentum and price. And obviously we've got the Davis boxes, right? So we can see on the second breakout of a Davis box to whichever direction, we can trade in that direction. So yesterday, Friday, we had our first break of the Davis. Yesterday, we had the second break. So right now, because we're quite far away from that Davis low, we have to wait a little bit, because if we get a reversal back to the upside and we can re-establish this box, the trade might be to the upside. If we get there and fail, we could short it from that level. So, it's all a question of just waiting and seeing what the market does today. I don't, put too much weight on sort of bounce rallies, because they tend not to last. So you've got to just be careful today. Like, today is not going to give you an indication whether this mood has changed, right? So this is the expectation. This is what we think is going to happen going up to middle of October. And I'll adjust this each day, right? This could be, down to 390 if we have another really bad sell-off. It could be up to 420 if we have a bit of a recovery. But we've got to know where the market could potentially land up, and then we'll see where we land up by 15th of October and move from there.
Well, good stuff as always. So you guys look out for this. All these indicators, the levels that he's talking about, and we'll get through this, right? We'll get through this September.
Yeah. This is not the first time it's happened. It's not going to be the last. It's, one of the things I always encourage people to do is understand the annual calendar. Trade to the annual calendar. September and October are always hard months. And it usually comes after a hard 3-4 months of summer, right? So usually what happens is in the summer months, people get really frustrated because it's choppy, low liquidity. It's hard to make money in summer. They get to the end of summer, kids go back to school and they're like, oh, I've got to make my money back that I didn't make it in summer. September, October knocks you out. And then you've got November, December, January, maybe February. That's where you make the bulk of your money every year, is literally November to February. So, for me, if I could trade just 5 months of the year, it would be November to February. That would be ideal. And then take February to November off and go and do jiu-jitsu. That would be phenomenal. But unfortunately, I can't do that because I'm old. And, it doesn't work for me now. But that would be ideal. That would be ideal. So, try and get an appreciation for the annual calendar. Keep yourself safe. Don't overtrade. This is normal. Build a system that works for you. And if you need help with the system, subscribe to us at rogueinvesting.com/alpha, and you can join in on the webinars on Monday and learn how to build your own system.
Perfect. Well, Chris, have a good day, man. And I will talk to you next week.
I'll see you next week. Take it easy, man.
Hey, take care.
See you. Bye.